inflation in two countries in West Africa. Ghana, consumer price inflation, it did decelerate 52.8% year on year in February, was 53.6 in January, according to the Statistics Service on Wednesday. It was the second consecutive month that inflation has slowed since reaching a more than two-decade high of 54.1% in December. Ghana is facing its worst economic crisis in a generation and is in the process of restructuring its debt in order to secure a $3 billion loan from the International Monetary Fund. The central bank has hiked its main lending rate by 13.5 percentage points in the past year in an effort to contain price increases. To Nigeria, inflation increased from 21.82% in January to 21.91% in February, year on year. 9 basis point increase. The National Bureau of Statistics revealed this in a recent consumer price report on Wednesday, just a few hours ago. After the nationwide Naira crisis and concerns surrounding the just finished presidential election, the inflation rate did increase. The NBS claimed that higher costs for oil, fat, fish, meats, vegetables, and other two items were part of that. Although month on month, we are seeing a deceleration from February through, or rather from January through to March. From January through to February. Let's discuss that with Ayodeji Ebo. He's the Managing Director, Chief Business Officer, Optimus by Afrinvest. You're very welcome, sir. Good afternoon to you. Thanks for joining us.
Thanks for having me.
So, I mean, what did you make of this year-on-year figure? I guess it did, surprise a few analysts. The Bloomberg estimates I think it was at 21.8% or so. How do you see these figures as for Nigeria now?
Okay, thanks. And for us, I think it's in line with the expectation. For Afrinvest, our forecast was 21.9.
Oh, okay.
Yeah, so there's the base effect because we're talking about year on year. So comparing February 2023 to February 2022. So there's that impact that impacted the figure. But if we want to narrow down to see what the impact of the cash crunch is to focus on the month-on-month analysis. And when you look at the month-on-month, you would see that there's a significant drop. So month-on-month from February, comparing it to January.
Yes.
Comparing the month-on-month change you discover in January to December. So we saw that drop for the headline inflation, which dropped from 1.87 to 1.7%. So, and even looking at the food inflation, that massive drop, I think 2% to about 1.9, and the core from about 1.82% to about 1%. So you will know that, observe that because of the cash crunch, most people even deferred most of the transactions because once you don't have cash, there were also a lot of failures in bank transfer delays. So that slowed down business activity significantly. So that's deferment of demand impacted on that on the month-on-month figures that we're seeing.
Yeah.
So for us to be able to track the impact of the cash crunch, to be more reasonable, to focus more on the month-on-month figures, comparing it rather than on the year-on-year figures.
Okay, great. So that you preempted my next question. So I guess when we're tracking these things, month-on-month is more accurate than using year on year, I guess, for these types of events?
Yes, it's more accurate because, most times it's also different dynamics. So we're trying to see what in January, the cash crunch wasn't that significant. And we saw that impact in February. So when you want to track that, it's the month it happened and versus the month that it did not happen. Right. That's when you can see the impact. But if we're looking at it on a year on year, we may not even remember those factors that determined the inflation rate in February 2022. That was the month when the Ukraine crisis started with crisis, but there's that lagging impact. It's more in February, March that we began to feel that impact. So that base effect is what made look like, despite the expectation that there would be a reduction in demand, we still saw inflation rates increasing compared on a year-on-year basis rather.
What does this mean for cost of living for the average Nigerian with these when we get these numbers coming in like this?
Okay, thanks. Looking at the dynamics, it means that if you look at it on a year-on-year basis, 21.9%, it means that the cost of living in the last 1 year has increased by 21% on the average. You know, the inflation rate is a basket, so it looks at different things. Food inflation is about 50% of it, and there are also other imported items, different things constituting that. So, you know, most times here, there may be some items that have increased by 100%. There may be some that has been very flat, and some might have also reduced. So it's the overall average that you're able to track.
Yeah.
But what it does when you look at that, so for even the investors, so you see that 20% in last 1 year, if you look at it on a year-on-year, the value of the real value of your investment has reduced by 20%. So you have 1 million, that's the value, purchasing power, like the way we would put it, is around 800,000 now. Means what you can buy with 1 million, for you can't buy it again because of the increase in prices. So what typically that would do is, for cost of living goes high, and with the relationship with standard of living, some things you feel you can afford before, you have to drop it or look for close substitutes to see whether there's an alternative. So as cost of living is rising, then you see that the standard will also be dropping, because what you can afford before initially, you may not be able to afford it again because of the increase in prices of goods and services.
So I think you just mentioned investors a moment ago. So what about investment portfolios? I mean, how do you still try and get a positive rate of return when you've got numbers like this?
Yeah, so I will always say investors need to be careful here. One thing you need to look at for is, how do you want to bridge the gap? Inflation is 21.9. NTB's rate just came out for 1 year.
You tweet them regularly, yes.
Yes, at 9.84% for 1 year.
Yeah.
So you'll be wondering, why will I invest at 9.84%?
Yeah.
If there's no alternative based on the risk profile of the investment, it is still better to gain 100,000 naira on 1 million for 1 year to bridge that gap of 200,000 impact of inflation on your investment. Most investors, not having this knowledge, will just hold on and keep that 1 million for 1 year.
Right.
You know, you are losing indirectly.
Yeah.
The value of that money that you are keeping, not investing, is declining on a daily basis or on a year-on-year basis.
Yeah.
So what investors should focus on is, how do they want to bridge the gap? Then your risk level will now determine what form of investment. If you can't do T-bills, that is 9.4. There are a lot of commercial papers within this period that is within 12-13% that you can also take advantage of. But it's good to look at the, I'll say, the credit rating of the issuer and the issue before you invest those things. So there will be other, that FGN Service Board too is there. I think last one was 10-11%. Then beyond those, in quotes, safe investment, even stocks may look volatile, but if you are able to get dividend yield of 10-11% on some stocks, it's also part of reducing that impact on yourself. So I always say that if you're doing nothing makes you worse off. You can't afford to do nothing with your just having your money sitting somewhere without earning any return.
There are so many Nigerians just not investing or saving.
Not investing or not just having it there, not earning any return. You are getting worse off. So you feel the hardship more because that savings that you think you are gathering, by the time you want to use it to purchase or do something meaningful, to decline, you need to increase the rate of your savings to catch up with the high rate of inflation.